Good afternoon, everyone.
Good afternoon, teacher.
Okay, we have 60 members in the class. I haven't got the list of the class yet, so I don't know how many students are there in the class. Okay, according to the university regulation, you are required to turn on your camera during the session, so please do so. Okay, hi, long time no see.
Hello, teacher.
Can see some familiar faces. All right. So you have K57, is that correct? And most of you are from, your major is in finance, I believe, because the name of the class is for finance students, right? Do we have any students from other majors?
Yes.
Yes.
Okay. Can you tell me what major you belong to? Sorry?
National Economics, K58.
International Economics, 58, yes. So we have blended students from K57 and 8. Okay. Okay, just a moment. So do you know me, or I have to introduce about myself? Probably I have some of the students that already know me from the last courses, right? For those who haven't been introduced to me, then I will introduce myself again. My name is Quyên. I'm a lecturer at Faculty of Banking and Finance, and my department is corporate finance. So I will be responsible for teaching you this course, financial risk management. So basically, this is my information. This is my email address if you have any questions related to the course, or if you want any advice or consultancy regarding education, you can email me. The course material I will upload onto a Dropbox link so that you can get access to it and download it and try to self-study at home. So I will appoint a person, the PIC, the person of contact, person in charge of the class, so that he will be like the student who connect the students of the class and me. But at the same time, you are always welcome to contact me directly if you have any questions regarding the module. As you know that we are in the period of social distancing, so we cannot see each other face to face, which is a very minus point. But if you have any question during the course, and if you want to, probably this would be like nearly the exam, and if you want to see me in person, we can always make an appointment. If it is not face-to-face meeting, it can be carried out online. Okay. So actually, there are 2 students contacting me regarding this module. Actually, I receive a personal request to join this class from 2 students. One is Long and another one is Ming Chang. So Long is the first one who contacted me, so I will appoint him as the PIC of the class, okay, person in charge, and Ming Chang will be assisting him as well. So we can call them like monitor and vice monitor. Is that okay, Long Min Chang? Will you help me?
Teacher.
Okay.
I will do my best. Thank you, teacher.
All right. Well, you know, being in charge of the class sometimes will give you personal experience, so that you would be, it would help you in teamwork and other skills when you graduate, and it will assist you in your future career. All right. So regarding a little bit about my background, so as you can see, I've been teaching quite for a while, about 15 years. So my major when I was in undergraduate was actually external economics, which is the very typical and well-known major in our university, because I was I used to be a student from Foreign Trade University, like you, long time ago. So when I graduated from the university, the FTU, I was recruited as the lecturer for Faculty of Banking and Finance. And when I entered the faculty, we were about to celebrate 1 year of establishment. So up to now, it has been 15 years already. So when I was recruited as a lecturer, I only spent about 6 months working as an intern. I think the teaching assistant was my first title when I first entered the university. And I spent about 6 months working at the university, and I applied a scholarship to go abroad and to study in the UK, starting with the major as finance. So I spent about a year, a little bit more than a year, because I, after graduation from the master degree, I was about to, I was thinking to stay in the UK just to get some personal experience. But when I graduated from my master degree, it was the time that if you read the news, or if you keep track with what was happening at that time, then you know that it was the period when we have the crisis, the financial crisis, right? It was in 2008. So it was really difficult to find a job, although I had a very good offer, but it was not for my major. And we have at that time, I remember my friend, one of my friends, he stayed in the UK trying to look for a job, and he spent like more than 6 months not being able to look for a job because of a lot of job redundancy in the UK at that time. So I returned home, working again as the lecturer position at Foreign Trade University, and then I spent, I think, 2 years teaching at the university, and then I applied the national scholarship, the government scholarship for my PhD degree, doctoral degree, and I returned to the UK, but another university. Previously, I was doing my master degree at University of Stirling, and my PhD degree was awarded by University of Southampton, which is nearer to London, for your information. So I spent about 3 years and about 6 months, 3 and then 6 months to complete all the PhD process, and now to return here as the lecturer at Foreign Trade University. So that is a little bit about myself, you know, so that you would be, you would know me a little bit about my bibliography. So I have a little bit of the experience in applying for scholarships. So if you guys have any plan to apply for scholarships, I will be willing to share with you. And if you are, how to say, during the course, if you can impress me enough, then I will be very willing to help you with your reference. And I think that this is very important for you, because right now, to my experience, I can see that a lot of corporations, a lot of businesses, when they want to recruit exceptional, outstanding, or good students graduated from Foreign Trade University, they request the reference from, you know, like academic lecturers or your previous boss, if you have any part-time job during the university undergraduate time. So that is why my advice to you is try to have, or to create connections with your academic lecturers, so that they can help you with the reference when you graduate, if you want to apply for a job, or if you want to apply for scholarships to go abroad, or to do anything in the future. Then it would be very beneficial if you get to know, or if you establish a relationship with your academic lecturers. And by doing that, you know, the best way is to get very actively involved in the module, right? During the classes, then you would be able to create good connection. And as you know, connections are very important when you get to the working world. All right, so financial risk management is the course that, to me, I think it is a little bit challenging. It is challenging to students whose major are in finance, but for international economics students, as to what I know, your background related to finance is not very strong. However, if you try your best to extend your knowledge by self-study and by getting involved in this course very seriously, I'm sure you can manage. You can manage through this. And a lot of my previous, my former international economics students are, after taking some courses in finance, then they change their favor. They change their interest into finance, and they started looking for master courses in finance. And I used to have a very good students, one of the very outstanding students in the class, whose major was obviously in international economics, and then he applied for the master degree in finance, and now he was, yes, he chose the university in France to study, and now he is staying in France to work. So as you can see, your limitation in working area is not only limited in Vietnam. You can always extend your chances in other countries all around the world, because basically all the modules that we are trying to build to incorporate in all the modules, we are using as the faculty, we are using all the best materials, all the updated materials that the university worldwide, all the university worldwide are using. And this is to help you like bridging the gap of education between Vietnam and other countries worldwide. So basically, you will be equipped with many tools, many pieces of knowledge that will bring you to be capable of working worldwide rather than working domestically. So this is a very good chance for you to, to acquire the knowledge, to learn the skills, and to open chances for you to work, to get to the world of, career. So talking about financial risk management, we are building this course in order not to limit yourself related to a specific risk, because when we talk about financial risk, it contains different risk, right? Different forms of risk. But we would be able to manage risk is the very important answer to the question of, do we have to be afraid of risk, or if we can manage risk, then we can limit the fear of risk, right? And for many organizations and many investors at the same time, then the risk is not scary when we can manage it, right? So financial risk management, when we talk about this module, what we want to say, what we want to build is to provide you a concept of what does it mean by risk, right? And if we can manage it, then we would be able to reduce our fear for risk. And every investor and every organization must be aware of risk and must be able to work out certain solutions in order to manage the risk. And therefore, we would be able to improve or enhance the performance overall. So the problem here is, if we have the awareness for risk, and if we work out the solution to manage the risk, then risk will not be that scary anymore to individual investors or international organization. So basically, what we are going to do in this course is to have an overview of what does it mean by financial risk management. But to be more specific, this course will provide you different tools using derivatives as to manage risk. So we focus on derivative tools in order to manage the risk, right? And because as you can see, different kinds of risk, we will have different kinds of measurement, different kind of tools to manage risk. But in this course, we focus on using derivatives to manage financial risk. And if you have read before, if you have come across with the news, then derivatives will include different contracts. And the four most popular one would be forwards, futures, swaps, and options. Right? Underlying these contracts, there might be thousands more contracts, and with different layers even with the contract that you come across, you may hardly find the original layer of asset, underlying asset, because under that contract, there may be different layers of underlying asset that you can hardly see the original layer. But don't worry, we will just look at these derivative contracts in the most simple way, and you will manage to understand the mechanism of these contracts and how to use this contract to for different purpose of managing risk. But normally we would look at the hedging side rather than other sides of using these derivatives, because as you can see, there are three purposes of using derivative contracts. They would be using the derivative contracts for hedging, for speculating, and for arbitrage opportunity. So basically, we look at these in order to differentiate the different objectives of using derivative contracts, but at the same time, we will learn about managing risk as long as making use of the arbitrage opportunity in order to achieve what we want to do with these derivative contracts. The last part, which is about, we would also discuss and try to look for information about how these derivative contracts would be valued using different ways, different tools, different models. And for these models as binomial trees and Black-Scholes and Mertens would be introduced to you to see how option contracts would be valued using these models. So this is basically what we are going to cover in this course. Okay, regarding evaluation, what we are going to do would be, the scale would be the same as other modules that have been covered in up to now to you. We would have participation, which accounts for 10%. And for this, I will randomly check your attendance 5 times during the semester, during the course. So each will account for 20%, so 2 marks out of 10. And remember that you have to have at least 4 points in order to participate in the final exam. So if you have 2 points out of 10, you are not allowed in the final exam, right? So this is the condition given by the university. So you have to follow. The midterm test would account for 30%. And normally, if we have the offline class, then I will organize the simulation test for you, and it would be the group test. But because we are not actually studying offline, and I don't know when we would have the offline classes, so if just in case that we would continue studying online for the whole course, then we would have the closed book test, okay? And it accounts for 30%. The final exam would be multiple choice questions plus problem solving questions, and it will account for 60%. All the problems solving question would be practiced in the class, so no worry, as long as you get involved in practicing all the questions given in the class, I'm sure you'll be able to manage in the final exam. But this is, according to my experience, this is what happened. If we isolate the different derivative contracts, right? For example, if you study about forwards, if you study about future, if you study about swap, if you study about option, you can do very well. I mean, when you practice the problems, you seem to be very good at solving the question individually. But when we combine all the contracts in the exam, they create confusion for students, even the best students. So what I want to say is, practice makes perfect, and try to study your best in order to be very clear of each contract and not to be confused when all the contracts are combined in the final exam. So passing this course is not very difficult. If you study, you can pass, definitely. But getting an A in this course would be a little bit challenging, and you have to try really hard for that, okay? But if you don't study, obviously you will fail, because this is not an easy course to pass, okay? So try your best. The A is not that meaningful, you know. You don't have to do everything to get an A, right? But sometimes getting an A is like awarding yourself with the feeling of being outstanding or something, right? And it would be an impression for the employers, obviously. But some students who do not graduate with the outstanding degree, they still get a job, and still they can climb up as a manager of a corporation. It does not really matter to do, you know, to try to get an A at any cost. This is what I mean. Okay, so basically, I will have a mechanism of awarding you a bonus point during the course if you are actively involved in the course. By actively involved, I mean that you are trying to contribute during the classes. If you are willing to volunteer to solve the solution, the exercises with your solution, then I will announce the class list of students who will be awarded the bonus point. Okay. If you have any questions before the exam, don't email me one night or a day before the exam. I won't be able to answer your email because it's very short notice. If you want to ask me many questions at the same time, and email is not the solution, because I cannot explain in details your questions, and it might be difficult to understand your question. So basically, you can see me individually, make an appointment so that I can solve all your queries. Plus, I don't have any kind of how to say, if you want me to, for example, increase your mark from B to A, it is out of the question. If you want me to reduce B to D, you know, that's out of the question. If it is very close to D, for example, if you got 5.5, and if you want to reduce your mark to 5.4 in order to retake the course, then I would be able to consider it, or 5.7. Sorry, 5.6 is the most. So within 0.2. If it is B, you want to reduce to D, it is out of the question. So don't email me with those queries, those favor, because I will not answer those emails, okay? Or if you want to increase from B to A in order to, you know, to be awarded scholarship, I don't think you deserve the scholarship if you gain a certain result by asking the lecturer to enhance, to increase your mark in order to get the scholarship or to get the good degree. I don't think it is possible. I don't think it is worth, because your effort will be shown in the final exam and your final total score. So try your best, and if you cannot get it, then don't do everything in order to get it, right? Because there are certain things in life that would be more important, okay? And your self-esteem is also very important. All right, do you have any questions related to the evaluation form? Have you got any questions? So far, so good. Okay. Questions? Okay, this is what we are going to use. This book, Option, Futures, and Other Derivatives by John Howe, is supposed to be the Bible in derivative courses. And this book is actually used all over the world by many universities in the world. I have attended courses in the US. Harvard University used this book. UK University used this book. French University used this book, and Asian University used this book. So this book is very well written and very clearly explained. So we are going to use the same one. Okay. I'll give you a soft copy of this book so that you can read it further at home. Okay, try to read it more, because we don't have enough time to explain everything in the class. So please spend some time self-study at home and extend your knowledge by reading a lot of materials. Okay, let's get started with chapter 1, which is a very first chapter to introduce you all the basic concepts. And these basic concepts would be the foundation, the background for you to get deeper understanding in the later chapters. Before we get to know the course, we should understand the meaning of risk, right? So what do you think? How do you define risk? How do we understand risk? What is risk?
May I answer the question?
Yes, please.
I think risk is a situation in which there are more than one outcome, and the decision maker does know about the probabilities of the outcome.
And your name is?
My name is Minh Trang.
Oh, Chang. Oh, hi, Chang. Okay, Chang. Anyone who wants to add certain points to Chang's answer? So Chang's defined risk as the situation where we have many outcomes, and these outcomes are attached with probabilities.
So I define risk as the chance that an investment that you invest in stock or a commodity will lose value, or someone think that it creates a hazard or dilemma for them.
Okay. So risk can cause dilemma or certain causes. Is that what you said?
Yes, it can put people in a hazard situation.
Okay. So are you scared of risk?
I think everyone is scared of risks, but maybe there will be some risk level.
Uh-huh. Okay, so basically we know that when we say it's very risky, it means that what? It's attached to certain something. And in real life situation, as well as in investment situation, when we talk about risk, do you agree with me that we want to say that the risk of losing our asset, our money, right? Or it is, let's say, it is the risk of getting what we do not want, or the risk of losing what we want. If we generalized it, then even in real life situation, we would attach it to what we expect, right? For certain thing to happen, and the risk of not getting what we expect to have. Is that correct? Is that correct? So when we talk about risk, we talk about the uncertainty of what we cannot predict in the future, or if we want something, the certain result of something, and risk is defined as probably the distance, right? The risk of not getting what we want, or the uncertainty in the result of something, right? So for example, if I invest in, let's say, stock exchange, right? So the stock that I buy, I expect to have the return, let's say, 20%. So when we talk about risk, the risk of investment, we may say, okay, 20% is my expected return, but I may have the risk of not getting what I expect. So, for example, it turned out to be like in this investment, it turned out to be that I would not get what I want, which is 20%. Now what I want is only 10%. So the difference between 10% and 20%, or even 5%, or even 0% or minus, when I lose, right? When I am not making profit, for example, then the distance from what I want and what I really get would be the risk, right? Is that right? So when we talk about risk, it might not be, in all situations, it might not be very bad, like a dilemma or bad outcome. Sometimes it is only, it only describes the situation where our expectation is one thing, and what I really get, what we will really receive, is another thing. Probably the distance from what we really get with what we expect would be short or long, depending on different outcomes, and it would define the, let's say, how risky the situation is, right? So when it comes to the definition of risk, then we can say we define risk as the possibility that the actual return will be different from our expected return, right? Because we have to have a benchmark to compare, and when we decide to do something, we always have the expectation for the certain thing. And for the investment, we do have the expected return, what we expect to receive from that investment, right? But if the actual return turn out to be so much different from the expected return, then the level of risk is actually increased. But the shorter distance between actual return and the expected return, then the level of risk would be decreased. It really depends whether it is very risky or it is a little bit risky, right? Or we can also define, if we put it in the distribution of possible outcomes, that if we have learned about distribution, then we understand that, okay, among all the possible outcomes that we suspect, we expect, that we work out, right, in different situations. So it is like, okay, when you establish a plan to do something, to invest something, if a company also work out the plan to possibly take the project, this project or that project, they would have to create different scenarios, right? And in these different scenarios, we would have to say, okay, in the, let's say, bad circumstance or in the downturn economic condition, then we would expect to have this outcome. In the other scenario, like in the normal economic condition, then we would expect this outcome. Or in the booming scenario of the economy, then we expect another outcome. So by establishing all the scenarios, different scenarios corresponding to different economic conditions, we would be able to create ourselves the preparation, okay, for any circumstance that could occur, right, and be ready to kind of pass all the obstacles of the situation. So the distribution of the possible outcomes around what we expect would be the uncertainty, right? And the uncertainty describe the risk. Understand? It's very simple. So when we talk about distribution, you will be very familiar with what is called standard normal distribution. And I think international economics students have learned econometrics. What about finance students? Have you learned about econometric?
Yes, teacher.
Yes, okay. So you will be experts in looking at this graph. When we have normal distribution, right, we expect that all our possible outcomes will distribute around a certain mean with a certain standard deviation, right? So basically, we have the middle, the mean, and the possible outcomes that distribute around the mean with a certain deviation to the left and the right. So we have left tail, right tail with a certain distance. So when it comes to risk, right, the measurement of risk would be the deviation, the standard deviation, or the variance around the mean value, which represent the expected return, the expected value. So the further the distance, right, from the mean value, from what we expect, would represent the level of risk, the higher level of risk for certain. Because basically, if the distance that the actual return would turn out to be is very far away from what we expect, then the investment would be very risky, because you know, as what we forecast to gain, the real result is actually very different from the expected result. Right? And the closer the distance, or the closer, the shorter the distance, or the lower the standard deviation from the mean, it means that the investment would have the lower risk for certain. Okay, so variance or standard deviation would be the measurement of risk, would be a standard measurement of risk. And as you can see, these are the formulas to calculate risk and return. So the average return, basically, we would take the average of all the possible outcomes that we forecast or we expect it to occur in different scenarios, and we divide it by the number of observation, and for variance, and then we take the square root of variance, which we would derive in the standard deviation. Then it would be the summation of each possible outcomes minus the mean, the average value, to the power of 2 divided by n minus 1. If we take the sample out of a whole population, then we would take n minus 1, right? And we take the square root of variance, sigma square, we would achieve a standard deviation. Okay. We also come across a very famous theory related to risk and return relationship, which is called the risk and return trade-off theory. And it goes like this. The relationship between risk and return is called a trade-off relationship. What does it mean by trade-off? Trade-off means that if you are willing to take high risk, right, then your expectation is the high return to compensate for the risk, the high risk that you are willing to take. But if you are the low risk taker, right, then your expected return must also corresponding to the level of risk that you are willing to take. So in other words, we have the positive relationship between risk and return, and high risk, high return would be what is called the relationship between, which describes the relationship between risk and return. High risk, high return means that if we are willing to take high risk, we expect to have high return to compensate for the corresponding risk, right? But if we only accept low risk, then we would expect low return in return as well. But as the risk taker, high risk taker, then there would be the circumstance that even if we are accepting high risk, the result does not turn out to be what we expect for all the time, right? So basically, we must accept that even if we accept high risks, the possibility of getting high return is not always the case. Okay, and if we compare between the risk and return trade-off between different investment tools, different investment products like T-bond, T-bills, large company stocks, small company stocks, then as you can see, the vertical line represents the annual return, the average annual return, and the horizontal line represents the annual return standard deviation, which represent the risk. As you can see, the small company stocks would be the investment financial products that has the highest risk in comparison with other instruments like large company stock, T-bonds or T-bills. But at the same time, as you can see, it possibly provides the highest yield, 18%, right, in comparison with other instruments. The objective of financial risk management is expressed in the graph as follows. As you can see, the bell-shaped curve represents the distribution of all the possible outcomes around the mean with certain standard deviation. And as you can see, we have two shapes. One shape is in purple and the other shape is in blue. So before financial risk management, as you can see, the bell-shaped curve is very flat, right? And after we apply the financial risk management, so we do incorporate some actions in managing financial risk, the bell-shaped curve is actually different. It's actually looking very normally distributed. And as you can see, we have different shapes of the bell, right? If it is normally distributed, then we would have the kurtosis, which is about 3, and the mean, the skewness, which is 0. So it does not skew to the right or skew to the left. It is evenly distributed around the mean, and the kurtosis indicates the flatness, the way that the bell shape look. In this case, as you can see, it's very flat. So this is actually a platykurtic bell-shaped curve, right? If it is very tall, then it would be platykurtic, right? And when it is very flat like this, it does not really tell us that these observations are normally distributed. And as you can see, the standard deviation around the mean is flatter, which means that the distance, or we call the dispersion of all the possible outcomes around the mean is actually more than the situation in which we apply the financial risk management. Right? The shorter the distance, the shorter the dispersion of the possible outcomes around the mean, as you can see in the purple line. Okay, so our objective of managing financial risk is to reduce the situation in which we would have the dispersion of all the possible outcomes around the mean, or we are trying to shorten the standard deviation of all the possible outcomes around the mean, around the expected value. Okay, so that is the definition of risk and the measurement of risk. Now we come across to what is defined as derivative. Okay, derivative is defined as an instrument whose value depends on or is derived from the value of another asset. Okay, so this is a financial instrument, or an instrument in general, right? And the value of the instrument is actually derived from the value of another asset, the real asset. And we can say the derivative is a contract, right? And the value of the contract is actually dependent on the value of the underlying asset written in the contract. So the derivative itself does not have the real, what we say, the physical asset, or even if it is a financial asset, then it does not represent an asset, the real asset. It just based on the value of the asset, another asset, to have, or it indicates the value of the other asset to represent the other asset. And we only trade the derivative based on that value, okay, the derivative value. And the famous contracts that stand for the derivative would be futures, forwards, swaps, options, exotics, and many other contracts that will have the distinctive features as derivative. So derivative comes from the word derive, as you can see. The value of the contract, of the derivative of the financial instrument, would derive from the value of another underlying contract, underlying asset. So the contract always have what is called underlying asset. Okay, so we based on the movement of the price of that underlying asset to have the value, the fluctuation of price of the asset, and we will trade the derivative contract based on the value of the underlying asset. Do you understand this definition?
Yes.
Okay.
Yeah.
Okay. So why do we need to have derivatives? Because it looks complicated, right? Because we don't base on, okay, why don't we just trade the asset rather than creating very complicated contracts to trade on it? Because the way of using the purpose of using derivatives, as we want to transfer the risk in the economy, and derivatives contract create a playground for many investors, and rather it is private investors or institutional investors, they would have a certain market or what we can say is more diversified investment tools, investment instruments, and we can transfer certain risk in the economy, and we can change the nature of investment. Later on, I will explain in more details how we can, change the nature of investment using derivatives. But by using derivatives, then the users would be able to hedge risk, and if they process the asset, they would be able to hedge the risk of price volatility. If we are not certain about certain things that can occur with the market, then we certainly can hedge for the volatility in the future if we process the asset. So that is the purpose of asset owners. For those who want to make use of the price difference between different markets or different market makers, then they would use the derivatives to, let's say, arbitrage opportunity. So basically, they buy at the lower price and they sell at the higher price, and they lock in profit as the difference in prices. And for those who are really high risk taker, they would want to speculate on the price volatility of a certain asset, and they come to derivatives and try to make use of derivatives in order to gain the speculation purpose. So derivatives can be set as a very important contract, a very important instrument in order to transfer risk in the economy and to create a more diversified instruments for players in the market to make use of, to use. And the underlying assets would be very diversified. It includes stocks in the market, it includes currencies, includes interest rates as the underlying asset, commodities as the underlying assets. So basically, those who are producers or exports and import organizations can also get involved in the market. They can be used, the underlying assets can be debt instruments. So as you can see, there are many complicated layers of underlying assets inherent in one derivative contract. There can be the price of electricity, insurance payout, even the weather for the farmers, right? The farmers can hedge against the fluctuation of weather when they can lose a lot if the crop is not going well. So many financial transactions have been actually embedded in derivative contracts, and sometimes you cannot see the original embedded derivative in the first place, or the underlying asset in the original contract, because many transactions have been embedded in a derivative contract. We also have what is called the rear option. The rear option is the rear option approach in assessing the capital investment decision, but it used to be very popular. Nowadays, rear option is actually not used as popularly as before. But if you want to extract more information about rear option, you can extend your reading to understand what rear option is. Okay. So how derivatives are traded? Derivatives can be traded on the exchange or through the OTC. Okay. The difference between exchanges and OTC, as you can see, that exchanges, right, are more standardized. So all the transactions that are going on in the exchange would be very standardized, would be according to regulations. And if we don't follow the regulations, we would not be able to be traded on the exchange. So exchange trading or transactions would be more standardized, would be more secured, would be less risky than the transactions on the OTC, okay, supposedly. But nowadays, there are certain changes regarding the transactions over the OTC, so that transactions on the OTC would reduce the certain risk. Right? But as you can see, derivatives can be traded on the exchange as well as over-the-counter OTC. And we will come to, the difference between these two. Usually, exchanges would be very famous exchanges, as you can see. Like in the US, we have the Chicago Board Option Exchange, or many exchanges all over the world. And over the OTC market, then usually we would have the market makers as bank or fund managers, corporate treasurers. They will contact each other directly. Okay. So talking about OTC, right? Exchange is more standardized, more regulated. OTC is lessly regulated and more risky, right? But that is the story before 2008. Normally, as you can see, before 2008, the OTC markets are largely unregulated. Usually, we have market makers who are the intermediaries, and they are those who will act as the organizations that quote bids and offers to different derivative contracts. And master agreements are defined or are used to define the transactions between parties. Okay. Some transactions are handled by what is called the CCP, the central counterparties. And CCP stands between the two sides getting involved in the contract, in a transaction. And CCPs can be understood as the intermediary, the middleman, to connect between two parties signing one contract. So sometimes we can understand that CCP acts as the same as the exchange. How about after 2008, after the year of the financial crisis, right? Since 2008, there is a large change for the OTC. It is become more regulated. And the reason why OTC market has become more regulated, because this is to reduce the systematic risk, right? Because as you can see, the collapse of the financial market in 2008 has brought us a big lesson of how to manage risk and how to do in our best to reduce what is called the systematic risk, because as you can see, the aftermath of what has been going after the financial crisis has put a lot of bad impact on the world economy. So to make the OTC market become more regulated, it would certainly reduce the systematic risk and increase the transparency between the transaction in the OTC market. And in the US and other countries, as you can see, the standardized OTC products must be traded on what is called the Swap Execution Facility, CEFs, and these are similar to what the exchanges do. CCPs, the center counterparties, must be used for standardized transactions. So we also have standardized contracts, standardized transactions like the exchange, and we also have what is called the central registry, and they will act as the central party that record all the transactions, all the trades. Okay. Although, as you can see, that OTC contains higher risk in comparison with the exchange, but the volume of trading of the OTC and the exchange, as you can see, over time for a period from 1998 to 2012, the size of the market of the OTC is actually much larger than the exchange, right? The involvement in OTC market seems to be very attractive to many investors in comparison with the exchange. What about Vietnam? Okay, we have derivative market officially established in 2017, and we based it on the very old stock market, 17-year-old stock market. What about before 2017? We do not have the, before 2017, actually we did have the market, but we did not have the officially market for future. Right? We had a market, but normally the market, derivative market, is actually used for corporation, for institutional investors rather than individual or private investors. And normally big corporations and banks, commercial banks, large banks will get involved in the transaction, and usually we would have swap, we would have option, and we would have forwards contracts going on, but we do not have future, because future is actually traded on the exchange only. But future market, or we say derivative market, is actually especially established, right? The future market is actually established in 2017, and the first derivative that was traded was future on VN30 index, and the planning to establish the HNX30 index and the government bond came later in the plan when it was firstly established. And initially, 7 security companies were the members of derivative market on Hanoi Stock Exchange, and these companies are clearinghouse members of the VSD, Vietnam Security Depository. And you know, the clearinghouse member, we will learn about the clearinghouse member and the function of clearinghouse member in the later chapter, and you will see what would they do, what would they act on the derivative market. Okay. So this graph shows you some transactions for the period from 2017 to 2020, and this is for future contract of VN30 index. As you can see, this is the volume of trading number of contracts over time. We have the open interest as the blue line, and we have the VN30 index, the fluctuation of the index over time. So you can see how the derivative market for future contract VN30 index changes over time. We also have the transaction for future contract of the government bond, but the government bond is for institutional investors only. Private investors, or we say individual investors, are not getting involved in trading the government bond, future contract for government bond. And we also have the establishment of the mercantile exchange, right? So as you can see, the Mercantile Exchange of Vietnam is also established, and it has the connection with many mercantile exchange all over the world. So we have the CME Group, which is a very famous Chicago Board of Trade for mercantile exchange. And we also have the exchange in Europe, Tokyo, New York, those exchange. So basically, the Mercantile Exchange of Vietnam has been established and has established the relationship, the trading with many other mercantile exchanges. And officially, we have the Decree 51 of the government, and it supports the activities, the transactions of the Mercantile Exchange of Vietnam. So the MXV, the Mercantile Exchange of Vietnam, is actually allowed to cooperate with many mercantile exchanges in the world, and they would have transactions, they would have activities to attract more investors, more importers and exporters all over the world. Actually, there are 4 industries and 21 products that are allowed to perform in this exchange, including agricultural products, industrial raw material, energy and metals products. So this is an overview of what we have in Vietnam together with the world, although the history is actually not very long in comparison with all over the world exchanges, but we are building step by step, building a stronger playground for investors, both private and institutional investors. Okay, let's move on with the purpose of how we use derivatives. So, as it is firstly introduced to you, we use derivative in order to hedge risk. Okay. The second objective of using derivative is to speculate. So, what does it mean by speculate? Speculate means that based on the price fluctuation or the direction of the price movement in order to gain profit. Speculate, normally talk about speculation, we talk about the risky way of using derivatives. And by saying it's very risky, it means that when we speculate on the future direction of the price movement, then we either can gain a lot or lose a lot. Okay, and this is the price that we have to take. That is speculation. So what does it mean by hedge? Hedging means that normally when you get involved in the derivative market as to hedge, you normally would have to possess the assets. So you are the owners of the assets. And what you want to do is to hedge, to protect yourself, let's say to provide yourself a tool to hedge, to guarantee or to ensure yourself against the price movement of the market. Okay, that is the purpose of hedging. And what about to lock in arbitrage opportunity? When we talk about arbitrage, normally your strategy will include the offsetting position. And by saying offsetting, I mean you have to carry out two actions at the same time. You buy in low, you sell out high in order to lock in profit. Okay, arbitrage opportunity will appear in a very short period of time. Right? And when you see the arbitrage opportunity, you have to lock in as soon as possible, because the arbitrage opportunity will disappear very, very soon, because the market will have to adjust the prices in order to not having the arbitrage opportunity. But in reality, there does exist some arbitrage opportunity. Okay, so that is the main differences. Those are the main differences between hedging, speculating, and arbitraging. Okay. Derivatives are used in order to change the nature of liability, because sometimes when you get involved in derivative trading, you do not have to use your own money. You can use leverage. You can use other forms of trading, but not to use your own money. For example, when you use arbitrage opportunity, when you make use of the arbitrage opportunity, you can buy and sell at the same time to offset, right? You can use leverage at the same time. For example, you can borrow, okay, or you can sell something that you do not own, right? Or you can borrow for a short period of time, by saying leasing. You can lease an asset if it is allowed in the market. So basically, this is the reason why we say derivatives change the nature of a liability, because sometimes you get involved in the transaction without using your own money. You use the leverage, you use other forms of leasing, you can sell something that you do not own. So it changed the nature of a liability. It also changed the nature of an investment, because basically you invest without incurring the cost, right? Because basically you have the offsetting position. You buy one thing, you sell another at the same time, and you still can make profit from the offsetting position. Okay. Let's see. This is the example of how the foreign exchange quote for the Great British Pound. As you can see, if this is the forward contract, so we have the definition of spot price, which is the price being traded at the current time. Then we have forward contract. When we say forward, it means that this contract will be undertaken forward, right? So 1 month means that this contract will be undertaken a month after, in a month afterwards. 3 months contract means that this contract would be undertaken in 3 months. 6 months means 6 months more, then we would have to exercise this contract. Okay, so this is the bid price, offer price, right? Listed for each contract. So when you see the quote on the exchange, we'll see something similar. And okay, now we come across to what does it mean by spot price and what does it mean by forward price? Okay, spot price is the price that you see, you know, if you decide to make transaction of a certain product or certain financial instrument, that is the price that you pay at the moment. So what does it mean by forward price? The forward price for a contract is the delivery price that would be applicable to the contract if were negotiated today. Namely, it is the delivery price that would make the contract worth exactly zero today. Okay, so forward price is understood as the price that when we undertake the contract or when we exercise the contract in the future period of time, then that would be the price that we have to pay for or we have to buy at that price, depending on the position of yourself in the contract. But theoretically, that forward price would be negotiated today, right? Because it is the contract between two parties, the seller and the buyer, and they would have to come to an agreement of how much they would agree to pay for or to sell the product for in the certain period of time, in a month, in 2 months, in 3 months, 6 months, depending on the length of the contract. So it is the negotiated price today. But please pay attention to this point. Okay, I highlight it over here. Theoretically, then it is the delivery price that would make the contract worth exactly zero. Okay, except for some transaction fees, then we expect that the delivery price would make the contract, the value of the contract exactly zero. Otherwise, they will see the arbitrage opportunity. Okay, so we just ignore some transaction fees. We expect that the delivery price, the forward price, would make the value of the contract today exactly equal to zero. Okay, and we understand that the forward price may be different for contracts of different maturities. And as you can see over here, we have bid price, offer price, that the price for different maturities would be different as well, right? Okay, and that is the definition of the forward price. So what about the forward contract? Okay, a forward contract is defined as an agreement between two parties, the seller and the buyer, to trade a specific or a specified quantity of an asset or an underlying asset. Okay, so each contract will contain an underlying asset, and it is an agreement between the two parties, the buyer and the seller. Okay, they come to an agreement to trade a specified quantity of an underlying asset. So, for example, 100 OZ of gold, or how many buckets of oil, or how many buckets of rice, or something else. And they specify the quantity of the contract, and they specify the price of the contract in the agreement. The price of the contract is called the forward price or the delivery price. Okay, and they have a specified time, or we say the delivery date of the contract and the delivery place of the contract. Okay. So we call the specified time as the maturity or delivery date and a place of delivery. Okay. So we can see this is an agreement. A contract. So this contract will bind the seller and the buyer together. Or in other words, we say they must have an obligation, or this is a must for these two parties to exercise their right or to exercise their obligation in the contract. Okay, and opposite to the spot price, we have the forward price. So opposite to the forward contract, we have the spot contract. And the spot contract can be understood as the agreement to buy and sell a certain asset today, right? And probably the delivery or the delivery time will occur probably sometime near the today signing contract. It does not require to be exactly today. It can be a few days after that. Okay. So we have the terminology that the party has agreed to buy has what is termed a long position. Okay, a long position. A long position is understood as the position in which that party will buy a certain asset. Okay, and the party that has agreed to sell has what is termed a short position. Okay, so as you can see, the way to remember this is short stand for sell, long stand for buy. Okay, so these are two positions in the contract, in the agreement, long and short. We also, okay, so long and short, buy position, sell position. Now let's take a look at this example. On May the 6th, 2013, a treasury of a corporation enters into a long forward contract to buy £1 million in 6 months at an exchange rate of 1.5532. So this is the foreign exchange contract, and this treasurer is actually enter into a long position, right? This obligates a corporation to pay 1,553,200 for 1 million dollars and pounds exchange, right? So basically, what do you see in this situation? What could be the possible outcomes?
The possible outcome is the exchange rate may lower at the time of November 6, 2013, and the party who enters the long forward contract may incur a loss because they could buy £1 million with the lower price because the exchange rate decreased on November 6, 2013.
What do you mean by increase and decrease? Okay, let's see. Let's say this.
I think that suppose the exchange rate appreciate to 1.6. So the party, the corporation, it will exercise its long forward and sell the obligation and buy the obligation at 1.5 55 and 32 and sell it at the market at 1.6 and gain the profit of
Okay.
1.6 minus 1.55 32.
Okay.
That is the first scenario, and the second one is the exchange rate depreciate to, let's say, 1.50. So at that position, the corporation will not exercise the forward contract, but to buy at the outside of the market.
Yeah. So there would be two possible outcomes, right? It depends on the fluctuation of the exchange rate. So let's say one is it will come to 1.6, and another one it will decrease to 1.5. Then can you calculate the outcomes of this? If 1 pound, right? Sorry, if 1 pound is exchanged to 1.6 and 1 pound is exchanged to 1.5, then what would be the outcomes? In this case, we make a gain or a loss. And how much?
Make a gain by 0.0468.
No, I want
dollars.
I want to know the value of the whole contract.
The
Then
first
it
one
would
will
be $46,800.
$46,800 as the profit, and 1.5.
The second one will lose $53,200.
Is that a loss or profit?
The loss if the corporation exercise its obligation.
There is no if, they have to do it because this is the obligation.
It's a loss.
Right. Yeah, so it's a loss. Okay.
Teacher,
okay, when they are in, anyone wants to say?
I just want to ask that is there any information about the contract premium or something like that?
No. We just ignore this.
Pay off.
Yeah.
Okay.
So when we enter a long position, what do we expect?
We expect the price to increase.
We expect the price to increase or decrease?
Increase.
Why?
Because you could purchase the products at a lower price specified in the contract rather than the increasing price in the future.
All right. So when we enter the long position, our expectation would be the price will increase so that we can buy at the lower price than the market price. Yeah. And when we enter a short position, normally our expectation is the price to decrease because we can sell at a higher price than the market price, and we can always go to the market and buy back the asset. So in this case, the treasurer enter into a long forward contract, right, to buy a 6 month, 1 million pound to exchange for the US dollars at 1.5532. So we create two scenarios. If it increased to 1.6, then is this what he expects?
Yes.
Yes, because if the exchange rate is $1 is exchanged for $1.6, then he only has to pay 1,550,000 3,200 to exchange for £1 million, right? But in another case, if the exchange rate is decreased to 1.5, then he will make a loss, right? And you have worked out the gain or loss in each situation. And remember, the forward contract is an obligation of the two parties. Once they enter, they have to fulfill their obligations. Okay, there is no way not to do it. Okay, so if we analyze it from a graph, as we can see, this is the profit from a long position. Oops. We have K. K stands for delivery price, and this is forward price. Once we enter into the contract, we have to agree on K, right? SD stands for the spot price at time T. So it's different from S0. S0 is the spot price at time 0, which is the current time at the moment. SD is the spot price at maturity, which means when we exercise the contract. Okay, so when we enter a long forward position, our expectation is to have the price increase in the future so that we can buy at the lower price than the market price. Okay, so when the market price is actually increasing, then this would be our profit. Right? This would be our the area where we make profit, and the payoff from a long position would be the difference between ST minus K. Right? And if the price decreased, this would be the area where we make a loss. Okay. Opposite, we have the short position, short forward position. When we enter the short forward position, our expectation is to have the price to decrease in the future. So if the price decrease, this would be the area where we make the profit. So the profit will be K minus ST for the short forward position. But if it does not come to what we expect, and the price increased in the future, this would be the area where we make a loss. Yes? Okay. So this is what we represent in the in the graph. Then we have, okay, that is the definition, basic definition about forwards. Now we come across to the future contracts. Future contracts are defined as agreements between two parties, obviously, to buy and sell an asset for a certain price at a certain time. So basically, as you can see, the definition represents similarly to what a forward contract is defined. But the difference between a forward and a future contract is the forward contract is traded on the OTC, where the future contract is traded on the exchange. On the OTC, if the forward contract is traded, then the terms and conditions of the contract would be adjusted accordingly with the agreement between the buyer and the seller. But the future contract, when it is traded on the exchange, then it would be standardized contract. And those who are getting involved in trading in the market would have to agree to buy, let's say, one contract, two contracts, depending on the volume, the size of the contract. So they do not have the power to change the terms and conditions freely agree like the forward traded on the OTC. Exchanges trading futures can be, worldwide. As you can see the list, if you look into the book, it would be a very long list. Okay, this is the example of a future contract. Okay, an agreement to buy 100 OZ of gold ounces. This is the unit of measurement for gold at the price of 1,400 per OZ per ounce in December. So as you can see, if you buy a contract, right, it contains already 100 OZ of gold. You cannot negotiate, okay, I only want to buy 50. Right? You can, let's say, buy half of the contract, or if it is allowed, but cannot say, okay, I only want to buy 90 OZ if it's not standardized, right? It's not really negotiable. Then you can sell 62,500 pounds at 1.55 as the US and British pounds exchange in March, or you sell 1,000 barrel of oil at the price of $90 per barrel in April. Okay, let's take a look at this to see what does it mean when you want for information and you want to you can explore an arbitrage opportunity. Now, suppose that we have the spot price of gold, 1,400 US dollars. 1 year forward price of gold is 1,500, and the interest rate is 5% annual. The question here is there an arbitrage opportunity? Is there an arbitrage opportunity?
Yes.
Who is saying?
So I think we must calculate the forward price after 1 year to see whether there's an arbitrage opportunity.
Mm-hmm.
So
how do you do it?
So I think we can calculate the forward price by take the 1,400 multiply with 1 plus 5% power to 1, and I think it's let me see. It is 1,470.
Wait. Okay, who is saying?
Me, Đức Anh.
Okay, Đức Anh, I cannot see your face, right?
Yes, my camera is broken. Sorry.
Okay, camera is broken. Try to fix it. Just a moment. I'll show the slides again. So how much profit can you make?
It's 30.
30? Yeah. What about the others? Do you agree with Đức Anh?
Yes, teacher.
Yes. Okay, so basically what Đức Anh is doing is, when you know the interest rate, we know the interest rate over here, which is 5%. Then if we apply the formula to calculate the time value of money, right, with the interest rate, then we would expect that the future price of the spot price to grow into after a certain period of time. And this is the 1 year period of time. So let's say the forward price could be the S price, which is the spot price, multiplied by 1 plus the rate, the interest rate, raised to the power of T, right? And this is, the T here is 1. So we can see how much, if we take into account the future value of the spot price, then this is supposed to be how much?
Um, 1,470.
Okay, 1,470. Right. After calculation, you can achieve this number. So if we see that, okay, if we consider the time value of money and we see that the possible forward price could be 1,470, and the 1 year forward price of gold is quoted at 1,500. So when we compare these two, we can conclude that there is a price difference between 1,470 and 1,500. And when we see the price difference, we know that there exists the arbitrage opportunity. So our answer to the question of, is there an arbitrage opportunity, is yes, there exists arbitrage opportunity because of the price difference. And now, what should we do? If we see the arbitrage opportunity, the thing is, according to the principle, the strategy that we should undertake should be to buy low and sell high. Is that correct? Buy low and sell high. And if the price, the forward price, is actually higher than it is supposed to be in the future, then what do we do? What do we do?
We lock a short position in the future.
We short. Yeah. We sell. Right? Sell high because it's higher. So we sell. We short. We enter the short position of a 1 year forward contract of gold at the price of 1,500. So I agree with you. Our strategy would be short F. Okay, at 1,500. What else? What else? Remember that in the arbitrage opportunity, there must always exist the offsetting position. So when you buy something, you have to sell something at the same time. Or when you sell something, you have to buy something at the same time. Because what we want to do is to lock in the profit as the arbitrage opportunity exists. We have the difference in prices. So when we short forward of gold, we have to buy
the spot market at 1,470.
Okay, we buy gold, right? We buy gold at spot price of 1,400. because we have gold, then a year later we would be able to sell. Otherwise, we won't be able to sell, because if we do not have gold, then what can you sell? And remember that derivatives change the nature of liability. So basically, what can you do? It changed the nature of liability. So normally we do not use our own money, right? We borrow, but actually we are not borrowing, because actually we have the asset to kind of back up for our borrowing. So at the same time, we borrow, right? We borrow 1,400 to buy gold at the moment. At the 5% interest rate. Okay, so this is our strategy when we see the opportunity. At the moment. Okay, now we have to work out, after having the strategies, then we have to work out the outcome of this strategy when the contract reach maturity. 1 year later, what would happen? One year later, what would happen? Pardon me for my writing. I use the mouse, so it's very ugly. Okay, 1 year later, we
earn 1,500 from the forward contract.
Okay, let's say we exercise the forward contract and receive $105. Okay, we exercise exercise forward contract and receive 1,500 or 1,500. We
repay the loan.
we pay back. How much?
1,470.
That's right. 1,470. So that's all. So we log in $30 for a contract. Okay. Everyone understand what's going on?
Yes.
Okay. You still can see my handwriting, right? Okay. We have the second case with similar details, but now we have the 1 year forward price of gold is 1,400. So do you see an arbitrage opportunity? And if you see an arbitrage opportunity, what would be your strategies and what would be your outcome?
There's an arbitrage opportunity, and we will enter to the long position.
I think I will leave this for you to think and do it at home. And next time we will begin with solving this question. Is this okay?
Yeah.
Yes.
Okay. All right. Okay, this is the very first chapter, and it will provide you very basic knowledge, basic definition concepts of how to think, how to, you know, reason, how to kind of establishing, you know, strategies, you know, put you into the way to use your logical thinking. And I go very slowly so that you would be able to adapt. And those who are very fast, very, you know, fast learners can move very fast. But for low learners, try to get used to the way to think. And then as we move on, you would be able to speed up. If you don't get used to it from the very beginning, you will be totally lost when we move on with the next chapters, because the products will get more complicated. So we have to develop the thinking from the very beginning in order to catch up with the later chapters. Okay. So try your best. If you have any difficulty, please raise your voice. You can text me or anything so that I can step in and help you